We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us today. We talk retirement. There's a lot on your shoulders as a retiree compared to your working years. Your working years, you got that paycheck every week, every 2 weeks, once a month, however you got paid, but you always had that check coming in. You get to retirement, where's it going to come from? Are you lucky enough to have a pension? Social Security is certainly one option. What else do you have? Do you have other things, rentals? What kind of income do you have coming in? Where's it going to come from? And is it predictable and guaranteed? That's certainly one of the keys to retirement. Then you think about, well, our investments. Markets get bumpy. What should I be doing? If I have to rely on the markets to fund my retirement, that can be a challenge because the markets go up and they go down. So that's something that Brian talks about every week on the program, is kind of the way you invest is a lot about your personality, but it's also about what you need. So we talk investments, we talk income, we talk insurance, we talk really legacy planning, we talk healthcare, Social Security, Medicare. There's so many things on your plate as a retiree. Brian and the team are here to help. If you have questions about any or all, 833-707-3030, 833-707-3030. There's no cost to you to chat with the team at Decker Retirement Planning. You can also go to the website, deckerretirementplanning.com, find out where the offices are, find out more about Brian and the team. But you can also go there, deckerretirementplanning.com, under the heading of Safer Retirement Education. There's about 12 different things you can download, including Brian's book on retirement, the Decker Approach book. You can get all of that no charge right on the website, deckerretirementplanning.com. Hey, Brian, how are you?
Good, Mark. How are you?
I'm doing well. And, we're going to talk about some of the challenges of retirement, but also like the investments and how do we do it and how do we protect our money and how do we grow our money and all of that. But really, it's a different mindset from our working years where we're trying to accumulate wealth to be able, hopefully, to retire someday, versus the retirement world of now we're pulling from all that money we've saved. It's now distribution. Accumulation strategies versus distribution strategies, they are not the same, are they?
No, Mark. Accumulation strategies get you to retirement. Distribution strategies keep you in retirement. So, for example, in your 20s, 30s, 40s, 50s, S&P goes down 40 or 50%, no big deal. Your income is coming from work. Every 2 weeks, you're kicking money into the 401k that's down. You have the time, 3 to 5 years, for the markets to recover, and you actually benefit from that down market. Now, let's switch it. Now you're 65 or older. The portfolio that you're drawing income from is down 30, 40, or 50%. That is a killer. So accumulation strategies get you to retirement. Distribution strategies keep you in retirement. So we're going to talk in today's radio show about some things that people probably have never heard about that they should have. So we're fiduciaries. We're a math-based firm. You're going to want to listen and learn about a two-sided risk strategy that's able to make money in up or down markets. It's been around for over 40 years. And this is the highest earning risk strategy out there. We're going to delve into that. But I want to start with generally the big picture and risk reduction. In distribution planning, we cut risk several ways. The first way is we cut it quantitatively. Mark, I just can't believe that banks and brokers advise their people with a 60-40 or 70-30 portfolio. 60 or 70% of all the assets that they've made in 40 plus years of working are still at risk. I think that that's insane. And so I hope that people listening know that there's a better way out there. So quantitatively, we would shrink your risk from 60 or 70% of your exposure to stocks down to about 25 to 30%. So that's adjustment number one, is to quantitatively shrink your risk. Adjustment number two, as far as risk reduction goes, is to completely eliminate interest rate risk. Interest rate risk is the risk that you have with bond funds losing money when interest rates go higher. Now, you can't see this chart on the radio, so I'm hopefully just will explain how this works. From 1940, in 1940, the 10-year Treasury yield was around 2%. In 40 years, it made its way up to a peak of almost 15% in 1980. Peaked in 1980. And then for 40 years, interest rates have trended lower for 40 years from 1980 to 2020. In August of 2020, we hit 0.47 on the 10-year Treasury. Mark, at that point, anyone who recommends bond funds at that point, bankers and brokers still were, just because, quote, we've always done it this way. In a rising interest rate environment, if you're owning bond funds, you are losing money. So in the last 4.5 years, the 10-year Treasury has gone from 0.47 to as high as 5. Right now, we're at about 4.2. People have lost about 40% of their money in bond funds. We do not have interest rate risk because we don't have bond funds. So that's something that we want to vocally share our opposition, that that's not a viable, good option for people in retirement. Now we have an interest rate cycle where interest rates are going up. But you say, Mark, the Fed is lowering rates. Why shouldn't we have lower rates on the 10-year Treasury? Since September of last year, in 2024, when the Fed has been lowering rates, interest rates on the 10-year Treasury yield has actually gone higher. Why?
Yeah, why? That's a great question.
Well, there's 37 trillion reasons why interest rates are going higher. The bond auctions where they have to replace when Treasury bonds mature for the 3 month, 6 month, 9 months, 12 month, 2-year, 3-year, 5-year, 7, 10, 15 and 30-year Treasury yields, those maturities have to be replaced when they come due. When they come due, they have bond auctions. They open the market window. They sell the bonds. The number of buyers have to equal the available quantity. So to equate the amount of inventory to how many people will buy, lately they've had to raise the yield. Interest rates have gone up because the risk of owning U.S. Treasuries have gone higher. Why? Well, the S&P, Mark, way back in 2014, we lost the AAA rating internationally during Obama's years when S&P, the rating agencies, took that away. Moody's and S&P, both rating agencies, are warning people about the level of debt. 37 trillion when our GDP is less than that. When countries have over 100% of their GDP in debt. By the way, all the G7 nations are in that spot. Every G7 nation in the world, all the major countries, have over 100% of their GDP in debt right now. Japan is the worst. They're at 3x. 300% of their GDP is X. And that statistic, traditionally, Japan is a bug looking for a windshield. And so all eyes are on Japan when we're talking about managing debt to see what happens when you get that out of control. But we'll see. But interest rates are trending higher. The Fed governs and manipulates the open market rate. They have control over the open market rate. They do not have control over the Treasury bond yield. So that's a very important distinction. When interest rates are in a rising interest rate environment like they are now, you don't own bond funds. So we are in a rising interest rate environment. The third way to lower risk is strategically. Now, again, if we've done our homework, and we have, if we are a math-based firm, and we are, and if we are fiduciaries, and we are. And by the way, let's take a minute. If your advisor tells you that that he or she is a fiduciary, here's a test. Rather than just say that that's not true, you can use this test. This is worth pulling over and writing down. There's 3 ways that you can know if your advisor is a true fiduciary or not. So test number 1, are they independent? Mark, if you're working with Merrill Lynch, guess what kind of mutual funds you're going to own?
Merrill Lynch.
If you're at Vanguard, guess what funds you own?
Merrill Lynch. No, Vanguard.
you're at Fidelity, guess what funds you own?
Fidelity.
So how independent is that? I mean, if you were looking for a large cap fund, it's highly unlikely that the Merrill Lynch large cap fund is the best fund in that category. So we do our research at Decker. We are independent company. We can work with anyone out there in any category. And so we're able to be true fiduciaries to our clients. We have a 6-figure research budget. We've done the homework. We know what is best for principal guaranteed and risk investments. So the first test to see if you're a true fiduciary is to see if you're independent. The second is if you are a Series 7 licensed broker, you by definition are not a fiduciary. A Series 7 broker is someone who gets a commission on your security investments. A Series 65 advisor cannot get a securities commission on your investments. Let me give you a rundown of some of the horrific investments out there that are commissioned investments with absolutely, I shouldn't say absolutely no disclosure, but very little disclosure. Most people, when they buy a variable annuity, which we think is horrible, they spend 5 to 7% just in fees every year. Usually there's an upfront commission of about 8% that goes right to the advisor, comes out of your money. And then every year there are fees that go to the mutual fund, fees that go to the insurance company, and fees that go to the advisor. 3 layers of fees that usually are 5 to 7% before you make a dime. We don't like them. We don't use them. We warn people to stay away from variable annuities. Second, the largest commission product out there is called non-traded REIT, usually 12 to 15% right up front, right out of your money. They don't price it in your monthly statement because they don't want you to have a heart attack and see that drop that came out of your money. They don't price it for 3 to 5 years and then they'll reprice it. Non-traded REITs, in our opinion, with all of today's products that are out there, very, very good products, there's no need to buy a non-traded REIT. Third example of this is C as in Charlie, C-share mutual funds. Is where you tell your advisor, I don't want any upfront fees. I don't want any back-end fees. And you say, yes, sir, yes, ma'am. And then you apply with no disclosure. You double their fees with a 12B1 fee, which is a 1% fee that comes back to the advisor, and they didn't tell you about it. And you can know if you have this fee if you have C as in Charlie, C-share mutual funds. But the worst one, Mark, is this last one that I'm going to tell you about.
All right, so we're going to get to that fourth thing that you need to know about whether independent fiduciaries, all those types of advisors you talk to, and C-share, mutual funds, all those kind of things. I'm going to make Brian wait. We're going to wait until segment 2 to get that answer that Brian's getting ready to give us. But if you have any questions, you're like, I have way more than 25 or 30% of my portfolio sitting in the market. I don't even know if I don't really need a whole lot of growth. I think I've already done enough. Then this is a perfect opportunity to talk with Brian and the team at Decker Retirement. Now, maybe you do need a lot of growth. Maybe you do need 60, 70% of your money in the market. Maybe. I don't know. Brian doesn't know until you reach out. How can they help? If they can, they certainly would love to do so. 833-707-3030 is the number. Again, there's no cost for this. There's no pressure. There's no obligation whatsoever. Just call them and say, hey, I've got some questions. I've got some concerns. What do you think? Do you think I can retire? When? I would love to. 833-707-3030. 833-707-3030. Back with more of Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning right after this.
Tax laws change, but smart planning stands the test of time. Don't leave money on the table. Let Brian Decker and the team at Decker Retirement Planning help you maximize your tax strategy. Call 833-707-3030 today.
Uncle Sam might need a loan soon. From you. We have over $36 trillion in national debt. Where do you think the money to pay for that is going to come from? Taxes. Believe it or not, taxes are at historic lows right now. But how much longer will that last? A Roth IRA conversion might be a good option when planning for your retirement because you can pay lower taxes now and avoid potentially higher taxes later on. Brian Decker and the team at Decker Retirement Planning have seen taxes rise and fall. They know what options you have to potentially reduce the amount of taxes you pay in retirement. Call the team at Decker Retirement Planning and schedule your tax analysis today. 833-707-3030. That's 833-707-3030. Uncle Sam needs money. Don't let him take it from you. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk. Always consult with a qualified tax advisor before making any decisions regarding a Roth IRA conversion, as there may be additional tax considerations.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Again, if you have questions, you have concerns, man, I wonder if we can retire. Well, when can I retire? Do we have enough? Are we going to be okay? Will our money last? 833-707-3030 is the number. Again, no cost to chat with Brian and the team at Decker Retirement Planning. 833-707-3030. Might be one of the more important phone calls you make, certainly today, to get some insight into where you are investment-wise, income for retirement. What's that look like? Are we going to be okay? What do we need to do? We're on the right track. 833-707-3030. I'm Mark Elliott. Glad you're with us. Brian, you were talking about C shares and interest rates. Where are you going? You were talking about, I think, the fees, the tools for your retirement that can certainly cost you a lot more than you even realize.
Right. We were talking about if your advisor is a true fiduciary, then number one, they're independent. We talked about how Merrill Lynch, Vanguard, Fidelity, probably not, because they're going to recommend their own products. Number two, that if they're Series 7 licensed, then they're able to make commissions off your products and get paid. A Series 65 advisor cannot make security commissions on your products. So a Series 65 advisor is the second test that you can know, along with being independent, that they are in your corner advising as a true fiduciary. And the third, I'm going to go back to this high fee example that you don't want to own. But the third test is if you're an RIA, a registered investment advisory firm. If you are, then you are a true fiduciary, a fiduciary that's required by federal law to put their client's best interest before their company's best interest. If they are not an RIA structured firm with a Series 65 licensed as an independent firm, then they are not a true fiduciary. But this last one, Mark, this is a warning to people that if it sounds too good to be true, it usually is. Mark, what if I told you, let me give you a guaranteed 7% for 10 years and then 4% for life? How would that sound?
Sounds good.
Yep. So you're 65 years old, let's say.
And I am 65.
Okay. And you give us 100,000, and in 7 years it doubles to 200,000. Now, how old are you at 10 years down the road?
75.
75. You've got 200,000. 4% on 200,000 is 8,000 a year. How long before you receive back your original investment of 100,000? Well, that's 12 and a half years. So now you're 87 and a half.
I thought I already doubled it though, from 65 to 75.
You doubled it on paper, but you didn't receive it. So for 22 and a half years, your rate of return rhymes with zero. It is zero. We don't like that investment. We don't use that investment. We warn people away from that investment. But that would be an example of something that sounds really good, but it is not. But Mark, I want to stay on risk reduction strategy. So we've done our research and found that the highest earning risk strategy out there, when you look at the biggest study ever done in Jake O'Shaughnessy's book, What Works on Wall Street, page 367, Appendix A, that is three things. In the top 15, they are three different things. They are, it is momentum, it is relative strength, and it is sector rotation. But in fact, those three things are one. So I'm going to explain this. Imagine every stock and ETF is ranked 0 to 100 based on relative strength. Relative strength is a function of price appreciation and volume. Momentum has you buying the top relative strength stocks in your portfolio. When something better comes along, you rotate into it. It is sector rotation. It is momentum. It is relative strength. Why is this important to strategically use momentum when you're retired? Well, it's because once you retire, you can't make up that money. It's gone. When you have a loss, you can't make up that money. Your income is coming from this portfolio that is now taken big hits. You cannot afford to take big hits, but inflation requires you to take risk. So that's a quandary. So we quantitatively dial the risk back from 60 or 70% to about 25 to 30%. We eliminate interest rate risk by not using bond funds, and then we strategically lower your risk by using momentum strategies. So in 2000, 01, and 02, the S&P during that 3-year period was down 50%. NASDAQ was down 70%. People took a huge beating. But during that 3-year period, momentum had you buying what was going higher, which during that period was real estate through the REITs, gold, silver, energy, pharmaceuticals, biotech, healthcare. You would have made double-digit returns each year for those 3 years because those stocks did well. And then when the markets bottomed in March of 2003, you would have switched over to what exploded to the upside for the next 4.5 years, which was technology, semiconductors, small caps, emerging markets. Those made huge amounts of money. Then rolling into 2008, that was a waterfall decline where everything went down with the exception of treasury bonds. Treasury bonds were up 22% that year. So you would have had mostly a cash portfolio because if nothing is going up, you stay in cash, and you would have owned a treasury bond position. Now, more recently in 2022, that was another rough market for people in retirement. The S&P was down 19%, NASDAQ down 33%. Bonds, their bond funds were down, their safe money, bond funds were down over 20%, and commodities across the board were down. Russia had invaded Ukraine, and everything was tanking with the exception of energy. The frackers, the drillers, the pipelines, the crude oil and natural gas companies made 15 to 20% when most people lost about 30 that year. So momentum is able to allocate your funds into what is going higher. Now, we're doing this radio show right after the Trump tariffs tanked the market really hard. Then the market started up again when he said he gave a 90-day reprieve. How do we know? Nobody on the planet, by the way, knows in the next 12 months which are going to be the best sectors to invest in, but it isn't, so far, it isn't technology, it isn't semiconductors. The leadership so far this year is gold, not silver. The GLD, the GDX are doing fantastic. That's the standout. But so is insurance companies. Their product is not tariffed. It's all domestic and the high margin product. Other sectors of the market, some of the REITs, not office REITs, because those were gutted when people stayed at home after COVID, but some of the REITs are doing well. Energy has been doing well, but it's recently started to go lower. So we sold our energy sector a couple weeks ago. Other standouts, this will make you laugh, Mark. Pawn shops. There's some stocks that are pawn shops across the country that are doing well. And anyhow, there's different types of companies that are doing well in this environment, but it's not the same as it was last year. And by the way, the markets have changed dramatically. This is very, very important. Another reason why we are using momentum. There's been 4 times that the S&P 500 has ever traded above a market valuation of 30 times trailing earnings. That's only happened 4 separate times. Once was 1929, markets traded above 30 times trailing earnings, and markets traded flat for 17 years. Second time, 1964, markets traded flat for 18 years. Third time, November of 99, markets traded flat for 14 years. The fourth time, November of 2021, we hit 32 times trailing earnings. Now, with 100 years of market history, The next 10 to 15 years of stock market returns will rhyme with zero. That means that any passive investment strategy, buying and holding stocks, mutual funds, indexes, or ETFs, will yield a zero return. And that is devastating for someone in retirement. So you want to make sure that you have the ability, and I'll talk more about this in the next segment, Mark. You've got to have the ability to use momentum to make money in the next 10 to 15 years.
Yeah, there's certainly a lot, I think, on everyone's plate right now with the tariffs that Trump's got going on, the Doge trying to find money and find the waste, fraud, and abuse. And certainly they've found a whole lot of that. But it's the markets have made people really nervous. And so the idea is, what is your strategy? Are you taking too much risk? Are you not taking enough risk? Are you taking the right amount of risk for your retirement? Because everybody's situation is unique. And that's how Brian and the team look at it. How can they help you and your situation? Should you make a tweak here or there? Would that change your picture? For most, Brian, I think this is, you can just give me a simple affirmative or negative. But I think for most of your clients, if they made, I don't know, $30,000 in the market, it would not change their lives at all. But if they lost $30,000, $50,000, that could make a difference. Yes?
For some of our clients, that's true.
Yeah,
for sure.
Not all, certainly. Everybody's situation is unique, and that's how Brian and the team look at it. If you'd like to walk through their process or find out where maybe you're lacking, or maybe you've already won the game and you don't even realize it, that would be nice to know. 833-707-3030 again is the number. Again, no cost for this at all, no pressure whatsoever. If Brian and the team can help you and it's a good fit for them and it's a good fit for you, maybe you'll be their client. But it's not a foregone conclusion. It's got to be a good fit for both of you. But it's really about you, and Brian and the team, can they help? They don't know if they can until you reach out. 833-707-3030, 833-707-3030. More of Safer Retirement Radio with Brian J. Decker of Decker Retirement right after this.
Do you need help ensuring any remaining assets that you've worked so hard to create are distributed to your beneficiaries in the most tax-efficient manner? If you would like to talk or meet with Brian about your legacy planning, call 833-707-3030. Again, that's 833-707-3030.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Again, the website, deckerretirementplanning.com. A lot of great information there. Plus, if you go to deckerretirementplanning.com, under the heading of Safer Retirement Education, there's like 12 different things you can download. And it's really just for your information, right? There's a checklist challenge, a sample income plan, 3 principles of retirement book, Brian's book on retirement, the Decker approach. It's all there, and you can download any or all. It's just there for your information. Then maybe you get some of that. Maybe you get Brian's book, the Decker approach book. And then you're like, oh, I got some questions. I wonder how this relates to me and my situation. Just call them, 833-707-3030, 833-707-3030. You know, you mentioned this a lot, where 1929, I don't know what it is, but it's the 30 times something or other. But anyway, it's, 1929 to 1946, flat. 1964 to 1982, flat. 2000 or 99, end of 99 to 2014, flat. 2021. So if you go using that theory, that means we're looking at 2035-ish before the markets get going again. But Trump and the tariffs and the Doge and all of that, Trump's a business guy. Do you really think the markets will be flat for Trump's entire term?
There's many sayings in the market, a couple that come to mind with that question. The most dangerous phrase in the world in the securities markets is, quote, this time it's different. the other saying I love, Warren Buffett says, it's when the tide goes out that you can see who's swimming naked. So I'll give you a couple examples. So there's a time to own Tesla and a time not to own Tesla. So the time to own Tesla is when it's on the momentum's charts to be all in, but there's a time to be out. So for example, in 2021, Tesla doubled. So from June of 2021 to January of 2022, it had quite the run. But from January of 2021, it was $275 a share. Mark, do you know what it's priced at right now today?
125.
No, 252.
Oh,
It has actually gone down in the last 4 years. So Tesla is a stock that there was a time to own it and a time not to own it. But even with the momentum strategies, there's times when you can pick off good runs. So in 2021, from April of 2021 to January of 2022, it went from 175 to 400. And it's done that a number of times. At the end of 2022, it was at $100 a share. And 7 months later, it was at 280.
but that's a perfect example of why normal Americans, we cannot time the market because we don't know when it's going to be at the highest and we need to sell it, or it's going to be at the lowest, we need to buy it. I mean, some of those, the dot-com bubble bursting, there were a whole bunch of people that got caught in that.
Right. So that's exactly right, Mark. We don't believe it's humanly possible, and there's many studies on this, to time the markets. Here's why. When markets are tanking and it is the right time to get in, people are afraid. Fear will keep them out of buying when they should. And when the markets are starting to go up, they'll say, well, I'll buy it on a buyback, but that never happens. So anyhow, when markets are higher, greed will keep you in, fear will keep you out. And that's why the S&P is averaging 9%, and most public managed portfolios are yielding half of that.
Yeah, I think, and you mentioned Warren Buffett. Warren Buffett's got a saying that says, when others are greedy, be fearful. When others are fearful, be greedy.
Yeah, that's another good one. Let's talk about in the next 10 to 15 years, if markets trade flat and you buy the S&P and sit on it, you buy the indexes, you buy the QQQ, you buy the IWM for small caps, and you just sit on those. With 100 years of history, you're looking at 10 to 15 years of zero return. But even individual stocks, most individual stocks will yield a zero return over the next 10 to 15 years. So I want to just make sure that people know that the momentum strategy is out there. And that's why we use it, because people in retirement, we want to strategically lower your risk, lower the times when the markets hit your portfolio hard. So we quantitatively lower your risk from 60 or 70% exposure to stocks down to 25 or 30. We eliminate interest rate risk by not owning bond funds. And we strategically lower your risk by using momentum strategies, where in an up market, when the S&P is trading above its 200-day moving average, that's a definition of an uptrend. When that happens, we have the offensive team on the field. The offensive team are aggressive momentum strategies that cherry pick the best parts of the market when the market's going higher. Typically, that's semiconductors, technology, and fill in the blank. When the markets are going down, you don't want to own technology. Technology takes major hits. Case in point, just in the last 4 months, Tesla's cut in half, exactly half. So you just can't afford to take those kinds of big hits.
Hey, before I'm going to ask Brian a quick question, but if you're listening to this show right now and you're in the greater Seattle or even Salt Lake areas, you can always go to the website to check out the upcoming events that Decker Retirement Planning has going on. The events are free. They're talking different topics, whether it's the markets, whether it's Social Security, whatever it is, any retirement financial topic, they will discuss those kind of things, but they have that opportunity for you. Just go to the website, DeckerRetirementPlanning.com, look under the events tab, and find one that you want to know more about and take advantage. There you go. You were talking about Tesla, and Tesla is one of those really crazy things that's kind of our country crazy part of this, where Elon Musk is a hero to the left, really, because he's, going to take care of the environment. It's battery cars. It's not the gas. We're not polluting the world and all of that. And then all of a sudden he joins the other side and trying to go through the government, waste, fraud, and abuse. And then the other side doesn't like him at all anymore because of that. So we've gotten way too political when it should be about the actual American citizens. But Tesla, because of that, is what's caused it to drop like crazy. So I don't know if it's the electric car thing. Now, Trump certainly has said we're not going to make everybody have an electric car, which is what the last administration said. So these kind of things, Brian, how does your team, I mean, this is where you go back to the computer trend models. Is that kind of part of this whole thing to try to figure out where you're kind of directing your client's portfolio? And obviously most of it's in the safe and protected side, but there is a key part of it in this growth side.
Right. So, Mark, this is an algorithm. There's no way that a human being can do this. So it's all computer generated on who has the highest relative strength. And then it picks those stocks until something better comes along and you rotate into it. It is sector rotation. It is momentum. It is relative strength. So I'll give you another example. This is a non-political stock, NVIDIA, the biggest makers of AI chips in the world. NVIDIA was the stock to own in 2020 and 2021. But in 2022, the stock went and dropped 65% into its bottom. And then in October of 2022, it ran from $11 a share up to $150 a share, January of this year, 2025. And then it dropped from $150 a share with the tariffs down to $90 a share. So there's a time that you want to be in these kind of stocks and a time that you want to be out of these kinds of stocks. And nobody knows. I could never do this. I've been doing this 40 years. I could never pick stocks. I never know where the best stocks are or what companies. Another one is, and this is another chip company, PLTR. PLTR is Palantir Technologies. That stock went, Mark, it went in 2020 to 2021, it went from $5 to $40. And then in 2022, it went from $40 down to $5. And then it went from $5 in 2023 to $92 where it is right now. So there's a time to own these stocks and a time not. And there's companies I've never heard of that show up. Like I mentioned that pawn shops are making a lot of money right now. So are insurance companies. They're doing well because they're not exposed at all to the tariffs and they're high margin business. So anyhow, that's where we're seeing money go, along with gold and gold stocks, GLD, GDX. But nobody can know when the time is to get out. Let's talk to the gold bugs out there, the people that buy and hold gold forever. Well, there's a time to be in gold and a time to be out of gold. I'll give you an example. So, Mark, did you know that gold was the place to be from 2005? It went from $40 an ounce to 2012. It hit $180 an ounce, or 1,800, sorry. Then it was flat from January of 2012. It was flat for 12 years. 2024, it was the same price.
What? William DeVay's been telling me I need gold for a long time.
Yeah, those guys are paid. You knew that.
Maybe he's paid in gold stock.
For the gold bugs, there's always a time to be in gold. There's always a reason to be in gold. Does gold protect you against cataclysmic events? No. Between 2012 and 2024, all kinds of stuff happened, including in 2022, Russia invaded Ukraine and gold went from 1,800 down to 1,500. It lost money. So that doesn't protect you. The indicator, the tailwind for gold appreciation is a declining U.S. currency, a declining U.S. currency. So if you look at the U.S. dollar falling quite a bit in the last year, that has caused the gold price appreciation, among other things. So that's the biggest reason. So once the US dollar bottoms and starts going up, you watch gold will start to level out and or go lower. But anyhow,
So
my
all
point is,
those gold bars I have in my closet, what should I do? Should I just leave them there?
well, if that's your emergency cash,
Yeah,
then keep them there.
Pull out a gold bar, go down to the pawn shop, see what I can get.
So when it comes to this part of the portfolio, the risk part of the portfolio, we want to make sure that we eliminate interest rate risk, don't own bond funds. We want to quantitatively shrink your risk by not having 60 or 70% of your portfolio following the advice of any banker or broker. We think that's crazy. Get it down to 25, 30%. And the third thing is strategically lower your risk where you own momentum strategies in the portion of your portfolio that is at risk. Now, the portion that doesn't have risk, we hope is 70 to 75% of your money are in laddered principal guaranteed accounts. Some of your money should be in cash. You've got to have liquidity in your portfolio. Set aside money for a new car or if you're going to buy a cabin or a second home or whatever, have that money set aside. You also use cash or cash management for, in our case, the first 5 years of income when you retire. Then there's bucket 2 and 3, which for us is a 3 and a 5 year CD. But where do you get the best rates? Do you get them from banks? No, you don't get the best returns on a fixed rate principal guaranteed CD from a bank. We've found that we get much higher rates by looking elsewhere and locking in those higher rates. And then the third thing is 7 and 10 year principal guaranteed. We're able to get much higher rates using variable rates investments. Now, AI has changed a lot of things. It's changing everything in our business when it comes to investments. So on the momentum strategies, Mark, AI is enhancing better entry points into stocks and exit points for stocks, indexes, and ETFs. We're seeing just in 3 months of testing with our strategies, the rates of return are going higher and the drawdown or risk is going lower. So AI is changing that. But when it comes to 7 and 10 year principal guaranteed accounts, I've been doing this 40 years. I've never seen the high returns that we're seeing with AI indexes on principal guaranteed accounts. The average annual returns for 10 years is double digits. Those are S&P-like returns. Now, do you make money every year? No, there's variable rates. So some years you might get 6, some years you might get 15, some years you might get 2, some years you might get 18 to 20%, and then the next year you might get 0. So they fluctuate, not that wildly, but I'm giving an example, they do bounce around. But average returns, double digits, are now available for the first time in my 40 years that we're seeing in 7 to 10 year principal guaranteed accounts. So if you're dealing with a true fiduciary, you know about these. If you're not, all this information that we're talking about today is brand new.
So here's the deal. If you have questions and you're wondering, boy, what if we could retire? What if we're in a good spot? Are we in the right lane with our investments? Or is our income going to be what we need for the rest of our lives? Are we going to be okay? If you'd like to come in and sit down with the team at Decker Retirement, talk about and really just take advantage of this free retirement review. Let's look at where you are. What are some of the tips the team's got for us? Will you become a client? I don't know. Brian doesn't know until you guys have a conversation. But it's really an opportunity for you to get really kind of a heads up, kind of a first look maybe at your retirement picture. Maybe you've never done that before, taking advantage of sitting down with a retirement planning team like Decker Retirement Planning. It's a great opportunity for you. No cost, 833-707-3030, 833-707-3030. Back with our final segment of Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning right after this.
Economic uncertainty is inevitable, but with the right plan, your finances don't have to suffer. Get the latest market insights and strategies from Brian Decker and the team at Decker Retirement Planning. Call 833-707-3030 to stay informed.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Again, Brian and the team at Decker Retirement are always talking about your retirement, about investments, about income, about taxes, about healthcare, about legacy planning, about Social Security, Medicare, all those things that are really big deals when it comes to your retirement. We're talking basically about the markets and volatility and how do we maybe have some of our money safe and protected. Those are the same kind of things that they talk about at their events. And you can go to the website, DeckerRetirementPlanning.com, to find out where and when and what the topic is at these events. The events are free. There's no cost to you to come in and sit down and listen to Brian or the team from Decker Retirement talking about all of these different areas, but you get to sit down in person and see them face to face and listen to them. And then if you have questions, you can certainly ask them, but it's an opportunity. If you'd like to attend an event, just go to the website, DeckerRetirementPlanning.com, find out when and where. Go, hey, that works for me. Then you just sign up and you're good to go. There's no cost. Great opportunity. And of course, if you just want to talk to them, I really want to find out where we are. I wonder if I do need to make a tweak here or there in my portfolio. I wonder if I do have too much risk or not enough risk. I don't know. 833-707-3030, 833-707-3030. All right, final segment, Brian. You covered a lot of ground, and I know now you're going to kind of weave into a different area, correct?
Right. We're not doing anyone favor by taking their IRA or 401k from 500,000 or 600,000 to 3 million. Now you have a tax problem, and we help create that. So we don't do that. We want to do IRA to Roth conversions in a way so it doesn't raise your bracket, but it allows you the biggest tax saving strategy for most people in the country right now, still. So here's an example. We're a math-based firm. So imagine someone at 60 years old with $1 million IRA growing at 6% a year. At age 73, they start taking their required minimum distributions, and we killed him off at age 90. How much tax did he owe? Well, in his life, he paid $676,732,000 in taxes, but wait, there's more. Because of the Secure Act, your beneficiaries have to pay the rest of the taxes. They have 10 years to completely exhaust and zero out the beneficiary IRA and pay taxes on it. That's another $718,496 for a total of almost $1.4 million in taxes. Mark, these numbers, this is the number that makes me sick to my stomach. After 30 years of $1 million IRA growing at 6% of the year, the net of tax transfer to beneficiaries is a measly 1.2. To be exact, $1,223,385. 1.2 after 30 years of growing at 6% per year. Now, the IRA is the most tax inefficient vehicle on the planet. So we don't want to continue to feed the monster. So here's what we do. We do Roth conversions. Mark, here's a stupid example.
Well, I think here's what you said one time, too, when you're talking about IRAs. The IRA stands for the IOU to the IRS.
Yep. If you're a farmer and you're raising corn, would you rather pay taxes on the weight of the seed or the weight of the corn yield?
I'm going to go with the seed would be my answer.
Correct answer. Okay. So in this case, you want to proactively pay taxes now so that all the growth is tax-free. A Roth account grows tax-free, distributes income back to you tax-free, and passes to your beneficiaries tax-free. free. So in this case, same 60-year-old, same $1 million IRA growing at 6% a year. But in this case, we convert $225,000 each year for the first 3 years and $50,000 a year, so that by the age 73, there's no IRA left. It's all been converted. We killed him off at age 90. How much tax did he pay? Did he pay 1.4? No. He paid $319,474. 1.1 in savings. Did he transfer 1.2 to his beneficiaries? No, he transferred 4.1. 4.1, more than 3x. So we want people to know that there's a right and wrong way to do IRA to Roth conversions. So this is where we look at their gross income minus their standard deduction to get their AGI, adjusted gross income. And then we go to the tax tables to see how much money we can convert from IRA to Roth without raising their bracket. So tax tables for 2025, let me give you an example. So there's a big difference between 24% and 32%, but not a big difference between 22 and 24. So Mark, if you're married filing jointly, you are in the 22% bracket, starts at 94,301, goes up to 201, and then you're going to the 24% bracket, 201 to 380, almost 384, 384,000. This is where we really do a lot of our Roth conversions. We don't want people to go from 24 to 32%. Now, once in a while, we'll have a client with a smaller tax base. You might be in 12%, which is incomes married filing jointly from 23,000 to 94,000. If their adjusted gross income is at 70,000, then we have 24,000 to convert from IRA to Roth before we bump them up from 12 to 22. So that's the right and wrong way to do it. We want to make sure that we don't bump their brackets. And secondly, we want to make sure that we do IRA to Roth conversions in the right area. Do we want to do IRA to Roth conversions in buckets 1, 2, 3, 4, or 5? No, we don't, because those are principal guaranteed accounts. The rate of return isn't high enough and you're taking the money too soon. It's only the risk bucket. The risk account is where we want to do IRA to Roth conversions without raising brackets. We look at it every year and we make sure we take advantage of it. So there's a right and wrong way to do IRA to Roth conversions, but there's so much more. When we talk about tax strategy, we look at everything. And many times we're on with CPAs, helping them, talking them through different ways that we can help them on tax strategy. For example, if someone has a spike in income during the year, we use donor advised funds for an offset with charitable contributions. If someone has huge capital gains exposures, there's the charitable remainder trust that allows us to eliminate the capital gains. If they have low cost basis real estate that they're selling, again, we'll use the charitable remainder trust to eliminate that capital gain exposure. If there's a big age difference between spouses, like 10 years or more, we'll use the Quadro, the Qualified Domestic Relations Order. That allows us to take half of their 401k, split it, give it to the younger spouse. Now we have a longer runway to do IRA to Roth conversions. If someone lives in a state with estate tax, we want to do planning so that there's a way to pay for that state estate tax by paying about 30 cents on the dollar and saving them a lot of money and headache by doing it that way. Mark, finally, if they have real estate, rental real estate, and they're getting a taxable income stream, there's a way to use cost segregation, which is accelerated depreciation, and a way to make that tax-free. The rental income, we make it tax-free back to the client. And there's so much more. But Mark, they should definitely come in and make an appointment and talk these things through. And I know you mentioned it, Mark, but if someone is listening to our show in the greater Seattle or Salt Lake areas, they can go to our website to check on our upcoming events and learn more. The events are free.
That is DeckerRetirementPlanning.com, DeckerRetirementPlanning.com under the events tab. And there you go. Find the events and the topic that you'd like to know more about. And you can attend the event for no cost to you whatsoever. Of course, at the end of the day, it's about you and your situation. What should you be doing? How should your investments be rolling at this point? Where are you? Do you need a lot more growth? You've already won the game. You don't need growth. It's not really a factor. You want to make sure I have safe and protected income. Where are you? I don't know. Brian doesn't know, but they're here to help and certainly give you some answers. 833-707-3030, 833-707-3030. Again, could be the most important phone call you make, and there's no cost. 833-707-3030. Brian, as always a pleasure. Enjoy the rest of your weekend. We'll do it again next week.
Thanks, Bart.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.